Hey everyone, in today's video, we're going to be talking about the top 6 Canadian growth stocks to buy. Growth is in a really interesting spot in the market right now. With interest rates gone up, there are some deals out there, so want to open your eyes to these 6 opportunities in the market. We're going to start with BRP Group. So BRP Group, we're going to talk about the company a bit in a second, but over the last year, the stock's down 10%. If I look at the company longer term, they're actually doing pretty well. So 40% over the last 5 years, 7-8% annual returns. It's a $2.6 billion company, so relatively small in the grand scheme of things. Looking at the types of products that this company sells, they own a lot of outdoor brands. So as you can see here, lots of Can-Am off-road vehicles, Sea-Doos for on the water. So these very expensive entertainment items, I guess you can call them, on-road wheels. They have these 3-wheelers that, depending on what climate you live in, you may see people ripping around on the street, go-karting engines, boats. They just acquired a boating company in 2019, right before the pandemic, which ended up being a pretty good buy, and some other consumer products that they have here to support their product line. So these are the types of businesses and the types of brands that they own. If you look at just about us here, or sorry, if you look at our brands here, you can see them all in a bit of a different way. Ski-Doo, I believe, is their biggest brand, but their boating brands and some of these other ones are also pretty big as well. If we look at how the company's been doing from a revenue perspective, you can look at 2019. The company did about $150 million, went up to $240 million. Remember, they bought that boat company in 2019, so that's why it's a big jump there. But then it went up again in 2021 as everyone was getting settled in from the pandemic, buying these types of products. Went from 250 to 560, and then 560 to $1 billion. Now, one thing to note, they're reinvesting a lot in the business, so their net income is essentially break even, give or take, minus a couple percent depending on the year. So that's something to watch. As they scale, they should be growing out of that and growing into a price to earnings ratio. But overall, this company is having explosive revenue growth, currently trading at about 2.5 times last year's earnings, and I think they're planning on growing a bit again. So probably at about 2 to 2.5 times forward revenue multiple, not earnings, rather. And hopefully as they continue to grow and grow and grow at that impressive clip that they have been on, they start to realize some efficiencies, some synergies, and get to profitability. But this one's still an early stage growth company that continues to grow and grow, but it gives you a really unique opportunity to get exposure to these outdoor businesses, outdoor products that are pretty unconventional, and they have really good market positions in them. So it's a really interesting business, growing really fast. Wanted to make sure you guys got your eyes on this one. The second one here is Alimentation, Couche. So for those of you who don't know, this company owns Circle K convenience stores in Canada and abroad. They also own a bunch of other brands in Canada and abroad. They are the largest convenience store company in the world, I believe. Going into this one a bit, this one in the last year has done really well, up 30% in the last year. In the last 5 years, Couche has delivered extraordinary growth of 135%. Price to earnings at about 16. Big company here, about $65 billion. Looking at their business a bit, they have over 15,000 locations. You can see here almost half of them in the US. Then call it 15% in Canada. Big businesses in Europe and international as well. You can kind of see the spots where they do have core networks versus they have international licenses where they get royalties for supplying those stores and those franchisees. So really big business that they've built, and they grow a lot by taking their acquisition, or their earnings rather, investing in acquisitions in emerging markets. So they're really a acquisition story in addition to the cash flow they're providing from their operations. You can see that here in terms of their growth. They entered the US in 2001, and since then they've just been growing all over the place. They have a huge business in Canada, and this company's actually sits in Montreal, I believe, now in Quebec. But they've grown in Asia. They also have one of the largest gas station presences in the world, because lots of these convenience stores are attached to gas stations. Not all of them, though. They do have a lot that are standalone. So they've been investing heavily in electric vehicle charging. If we look at the stock, it's been a bit of a couple dips on that road. And I think lots of that's come with concerns on the CapEx required to transition into electric vehicle charging for the stations that they run. But it seems like investors have recently shrugged that off. Feels like they're in a good spot, or that they have a lot of time. So lots of acquisitions here. Expect them to continuing to grow their site count, I guess is what they'd call it, in coming years, as they continue to drive a lot of profitability and looking for areas to grow scale globally. Going into the third stock here, the third Canadian stock I want to talk about here is Well Health Technologies. This one, just looking at the stock chart, came from about under 50 cents all the way up to $10 during the pandemic. And it's been jumping around a bit here lately, but currently at about $4.50. This company's at $1 billion market cap here. If we look at their revenue annually, they went from 50 million in 2020 to 300 million in 2021 to 600 million in 2022. And I think they're forecasting really strong growth again for 2023. So Well is essentially a healthcare company. If we look at their chart here, they are a healthcare company that acts in a couple different ways. First of all, they do actually own some clinics outright themselves, about 140 walk-in clinics and different types of clinics across Canada. But what they're really focusing on is software as a service in the space of healthcare, and with walk-in clinics and other clinics. Administration cost is a huge percentage of SG&A for lots of these companies, and it's a really old school business. So they are developing new technologies, getting more and more users and clinics on their software to drive efficiencies at these clinics, especially when an individual may own multiple clinics, can kind of put everything together. And they've had a lot of success in driving penetration there. They also bought a business in the US. So US Patient Services, you can see here the amount of clinics and the type of work that they do there. But overall, I think lots of the focus is on the software as a service and the technology aspect of the business. They are free cash flow positive, actually doing pretty well on free cash flow. If I was to look here, and these numbers are a bit dated from the end of last year, but I believe their free cash flow on the year was supposed to be about $150 million. So trading at a pretty low free cash flow multiple, especially for the growth rates that they're having. I'm trying to see if I can find that number. Let's see. No, just generating significant positive free cash flows reiterated there. Pretty sure it's like 100 to 150 million. So as I look at their new valuation of about $1 billion, they're probably trading for about 6 times, give or take, their free cash flow levels. The fourth Canadian growth stock I want to touch on here today was Nuvei Corporation. This corporation is a payment company. You can see here some of their growth. So they went from 150 million in 18 to 250 in 19, 375 in 20, doubled again to 700, and now this year is at 850. And then the other thing that's nice to see is you can see the last 2 years they've been consistently profitable. I think they're forecasting another profitable year this year. So they've kind of gotten over that hump. Looking at their stock price a bit here, over the last year, this one's gone down about 13%. Last 5 years down as well. So this one really hasn't found its way yet. You can see it skyrocketed up to $150 a share during the summer of 21. But like most other stocks with a similar growth profile have dipped back down. What is Nuvei? Nuvei is a Canadian fintech company. They essentially offer businesses efficient ways to enable payments from all kinds of different payment structures and softwares. They call them next-gen payments, offer all payout options that you can think of from card issuing, banking, risk, fraud management services. So in addition to like enabling payments of all kinds, they also sell a bunch of other services to merchants. If we look at where they are, the nice thing about this for a Canadian investor is they're a very global company, at least working towards being a very global company. So you get some international exposure here. They work with a lot of different currencies and a lot of different markets, and a ton of their volume is via e-commerce, which is a growth trend globally, especially in some developing markets still. So that's a bit of a unique one that you can get exposure to as a Canadian investor for some broader geographical reach. Currently trading at a $5.3 billion valuation. So as we look at their latest numbers, they're $850 last year, trading at about, let's call it 6 to 7 times prior year revenue. And from a price to earnings ratio, it's really high as they continue to scale and grow quickly. But hopefully this will come down in 2023 and beyond. Okay, going to the 5th Canadian growth stock to consider buying, Aritzia. So Aritzia is having a bad day here today with the rest of the market. But overall, $3.9 billion company trading about 21 times earnings. This one's seen really consistent growth on their business, going from $850 million rather to $1.5 billion to $2.2 billion. So in the last 3 years, the company's essentially tripled their revenue, and we really see no slow of it. I looked at their last quarter earnings, which I'll show you right here, and their earnings on the last quarter even were up 44% on revenue than they were a year ago. On the whole year, it was up 47%. So really, really strong, persistent growth as they open up more and more franchises, not franchises, but boutiques, they call them, in the US market. Looking here at where they say that they are played, they consider themselves everyday luxury. So nice products, but not crazy expensive, affordable to the vast majority of the population here. Looking at what they've grown to as a business, they're in 114 boutiques, and recently they almost had no presence in the US. They've grown that to 46 in the US, grown really quickly. And one of the reasons why, you can see here, the new boutique payback is 12 to 18 months, which is really strong payback times for this industry. So they can just open up stores, 3, 4, 5 stores. In 12 to 18 months, they recoup their investment that they laid out to get those stores in their system, and they can just continue to allocate that capital, open more and more stores. Their e-com business has just been exploding as well. They talk about the percentage of sales they do on e-com and how much they're investing in that growth pillar. And just they have a lot of things going for them as a business to accelerate and get this growth in the 40, 50, 60% range that they've seen the last couple of years. Of course, it's going to slow down, just law of large numbers. But overall, this has been a really good Canadian growth stock for lots of people. In the last 5 years here, the stock's up almost 120%. So you can kind of see it's pretty volatile, but overall it's done really well. They have a lot of tailwinds that they can ride back to $50 a share with how quickly they are opening up stores in the US, their structural economics, their e-com business. So this is a really interesting stock to keep on your watch list if you're interested in the fashion space. The 6th and final Canadian growth stock to consider buying is goeasy. So goeasy is a non-prime Canadian lender. Looking at this company over the last 5 years, it's up 180%. In the last 1 year, just up 12%, but honestly not too bad. You also get about a 3.5% dividend. Pretty small company, under $2 billion, trading at 11 times earnings. Looking at their earnings and their revenues, you can see here in 2019, they did $400 million, went up to $460 million, so 15% growth, another 15% growth, and almost another 15%, probably closer to 11 or 12% growth. So their revenue CAGR has been in the teens. They've been really profitable. It's gone up every year. A bit of a dip last year, probably some provisions for credit loss. But essentially what this company does is provide loans and mortgages to consumers who can't get them from a Big Five bank. Big Five banks have really strict requirements for getting a line of credit, car loan, mortgage. So this company fits a need by giving them a bit of a higher interest rate to account for some of the risk, but providing these essential services for more and more Canadians. And they still get collateral. They still, for the most part, are dealing with people with decent jobs, stuff like that. So they've really proven out this model, created a lot of value for their shareholders, especially over the last 5 years here. Once again, you can see with these type of growth stocks, during summer of 21, this stock was over $200 a share. So it's really come back nicely, potentially an opportunity to add to your watch list. As interest rates go down on all of these stocks, we'll see revaluations, price to earnings ratio, and revenue multiples expand as investors look for other places to put their money because they can't just yield 5 or 6% on a cash account. So I think it's an interesting opportunity to look at some of these stocks like Aritzia, BRP, Alimentation, Couche, Well Health as a potential growth spot in your portfolio for when interest rates go down and the valuations on these go up. But in the meantime, lots of these companies are growing really nicely. So you're getting that growth as you wait for macroeconomic trends to work in your favor too. So that's what I got for you today. If you like this video, be sure to give this video a thumbs up. It really helps a ton with the YouTube algorithm. You have no idea, to get these videos out to more people. I'd really appreciate that. If you haven't yet and you want to see more content like this, be sure to subscribe to my channel. I also really appreciate that as we chase towards 1,000. And I want to thank you guys for stopping by, and I'll see you guys in the next one. Thanks.